Warren Buffett paid an 18% tax rate in 2015. His secretary paid 35.8%. Same country, same IRS, same tax code. He literally went on record and said it himself that his receptionist pays a higher rate than he does. And the IRS data backs it up. That's not a glitch in the system. That's the system working exactly as it was designed to work. Just not for you.
The average American household in the middle class pays somewhere between 22% and 24% in federal income tax, according to IRS data. On an $80,000 salary, that's roughly $17,000 to $19,000 walking out of your pocket every single year before you even see it. Meanwhile, someone sitting on $2 million in investments is paying 15% on every dollar those investments generate, sometimes 0%. Dead serious. And the wild part is, it's all sitting right there in the tax code. No secret handshakes, no offshore accounts, no illegal moves. Just knowledge most people don't have. So what's actually going on here? How does this work? And more importantly, what parts of this can a regular person actually use? Here's what nobody tells you when you're sitting there every April watching TurboTax calculate how much you owe. The tax code isn't one rule book that applies to everyone equally. It's two rule books. One for people who earn money by working, one for people who earn money by owning things. And if you're a W-2 employee getting a paycheck every 2 weeks, you are playing by the hard rule book, while an entirely different game is happening right next to you. The first thing you have to understand is the difference between earned income and capital gains income. This is the foundation of everything. When you go to work and get paid, that money is classified as earned income. The IRS taxes earned income at ordinary income tax rates, which go all the way up to 37% depending on your bracket. But when a wealthy person sells stocks they've held for over a year or collects dividends from investments, that money is classified as long-term capital gains. And long-term capital gains are taxed at 0%, 15%, or 20%, depending on your total income. That's it. That's the split. The government straight up taxes work harder than it taxes wealth. That's not an accident. That's been baked into the tax code since 1921. Now here's where it gets interesting for regular people. If your taxable income is under $44,625 as a single filer, or under $89,250 if you're married filing jointly, your long-term capital gains tax rate is exactly 0%. According to IRS Publication 550, if you are in the lower half of the middle class and you're invested in index funds or dividend stocks and you've held them for more than a year, you could be paying absolutely nothing on those gains. The first move: open a taxable brokerage account, invest in broad index funds, and hold them for at least 12 months. Understand where your income falls relative to that $44,625 threshold. If you're under it, you're in the 0% bracket. The second strategy is low-key one of the most powerful tools in the entire tax code: the Health Savings Account, HSA. An HSA is the only account in America that gives you a triple tax advantage. 1. Contributions are pre-tax, reduces your taxable income right now. 2. Tax-free growth. The money grows completely tax-free inside the account. 3. Tax-free withdrawals. When used for qualified medical expenses, you pay 0 tax. For 2024, the IRS allows you to contribute up to $4,150 if you're single, or $8,300 for a family. Now, here's the pro move. You don't have to spend that HSA money right now. You can invest it in index funds inside the account, let it grow for years, keep your medical receipts, and reimburse yourself decades later with zero taxes owed.
Here is the missing link. Your credit score and your tax strategy are directly connected. The wealthy pair tax strategies with prime credit, 780+ scores, to get portfolio loan rates as low as 2 to 3%. Why? Because borrowing is not taxable income. Your credit score is a tax tool. Lower credit score equals higher borrowing costs, equals less ability to defer taxes. This is called tax loss harvesting. Let's say you have two investments. One is up $5,000 and one is down $3,000. If you sell both, the $3,000 loss offsets $3,000 of your gain. Now you only owe tax on $2,000 instead of $5,000. You've essentially been paid to clean up your portfolio. The IRS allows you to deduct up to $3,000 of capital losses against your ordinary income per year if your losses exceed your gains. Just remember the wash-sale rule. You cannot buy the same or substantially identical stock within 30 days before or after the sale, or the IRS disallows the loss. This is the billionaire strategy. Instead of selling assets and triggering a tax event, wealthy people borrow against them. Example for a regular person. You have $50,000 in stocks. You need $10,000 for a home improvement. Option 1. Sell. You sell $10,000 worth of stock. If half is profit, you owe 15% on that $5,000 gain. You pay $750 to the IRS and lose future growth. Option 2. Borrow. You take a portfolio line of credit at 5% interest. You pay $500 in interest over the year, but $0 to the IRS. Meanwhile, your full $50,000 portfolio continues to grow. If your portfolio grows by 8%, $4,000, you've made $4,000 while only paying $500 in interest. Sometimes borrowing is cheaper than selling. 1. Check your bracket. Go to irs.gov and find your specific threshold for the 0% capital gains rate, $44,625 or $89,250. 2. Open an HSA. If you have a high deductible health plan, open an HSA. Fidelity is a great option. And start investing. 3. Review for losses. Before year-end, see if you have red positions you can sell to offset green gains. 4. Fix your credit. If you're below 700, get it to 740 plus to unlock the ability to borrow against your assets at low rates.
The system is built differently for people with money. But the gap is closing because of access to information. These aren't secrets. They are in the tax code. The only thing missing was someone breaking them down in plain English. That's what I do here every week.